Hello everyone, good afternoon and welcome to today's session. I am your moderator for today's webinar and my name is Abhirami and I am the Client Engagement Coordinator here at AMCA. For all the new joiners in this webinar, I would like to give a brief introduction of our company. We are from AMCA, Abdullah Al Masouki Chartered Accounts. We are an auditing firm in UAE with a decade-long experience. We are registered with the Ministry of Economy to operate as a licensed auditor and a tax agent from Federal Tax Authority (FTA). Again, I would like to thank all of you for taking the time to join us today as we talk about corporate tax analysis on deductions under the corporate tax regime. Ms. Neha, our speaker for today's session, will provide us the guidance on deductible expenditure and non-deductible expenditure. After the discussion of this topic, you can drop all the questions on our chat box and Ms. Mariam will be joining us to answer all your questions by the end of the first half of the session. So without further delay, I will give the floor to Ms. Neha so we can start the discussion.
Good afternoon, one and all present for this insightful webinar where we shall discuss about deduction under corporate tax regime. So the main pointers for this webinar would be a brief introduction to deductions and deductible expenditures and non-deductible expenditures as presented in the screen. Deductions. Deductions are one of the adjustments that a taxable person must do or consider from its accounting income for the relevant tax period to derive the taxable income for that specific tax period. Corporate tax deductions are expenses that businesses can deduct from their taxable income. By taking advantage of these deductions, companies can lower their tax liability. But it's not just about saving money. Claiming the right deductions can also help your business grow and thrive. So taxable income is computed after allowing for expenditure accounted under the relevant accounting standards and also after making the required adjustments to the accounting income for expenditure item. So basically business expenses can be either of the following for corporate tax purposes. One is deductible expenditure and the other is non-deductible expenditure. Deductible expenditure. Theoretically, business expenditures that are legitimately incurred wholly or exclusively for the purpose of the ordinary course of business of a taxable person are considered deductible for corporate tax purpose. Adding to this, expenses that do not meet this primary condition will be considered as a non-deductible expenditures and therefore be added back to the taxable income if it has been included in deriving the taxable person's accounting income. It is important and efficient to consider if the expenses were incurred in direct connection with the business or business activity. Expenditure which is incurred for more than one purpose can be considered deductible under certain limitations and circumstances. Also, if an expense incurred for the business or business activity of a taxable person partly and for some other purposes can also be considered as deductible expenditure, provided that the expenses should be apportioned, allowing only the amount directly correlating with the business or business activity of the taxable person to be deducted. By doing so, the taxable person's relevant facts and circumstances should be taken into account and with fair and reasonable basis, amount apportioning must be done. For capital expenditure, deductible amounts will be recognized by way of depreciation or amortization of the relevant asset or benefit over its economic life. Deduction timing may vary for different types of expenditure and the accounting method applied, which is cash basis versus accrual basis. If you do it when you pay or receive money, it's cash basis accounting. But if you do it and when you get a bill or raise an invoice, it's accrual basis. Interest expenditure. So basically, deductions made under interest expenditures are supposed to be applied after the adjustments as stated in the article of corporate tax law are made on the accounting income for that period. In respect of interest expenditure, with the effect that interest paid in relation to exempt income is prima facie deductible, unlike other expenditures incurred in deriving exempt income. The net interest expenditure of a taxable person for a tax period refers to the aggregation of the interest expenditure incurred during the tax period and the amount of any net interest expenditure unutilized and was previously disallowed due to limitation. So interest is defined in corporate tax law as any amount accrued or paid for the use of money or credit, including premiums, discounts, and profit paid in respect of an Islamic financial instrument and other payments economically equivalent to interest, and any amounts incurred in relation with the raising of finance, excluding payments of the principal amount. Interest expenditure is considered as deductible for corporate tax purposes, but it is again subject to certain limitations. So now we'll be discussing on general interest deduction limitation rule. The allowable deductions for the taxable person's net interest expenditure must not exceed 30% of the taxable person's EBITDA, which means accounting earnings before the deduction of interest, tax, depreciation, and amortization. We're talking about de minimis net interest expenditure. This is something where the net interest expenditure exceeds AED 12 million. A taxable person may deduct the higher of AED 12 million dirhams or the percentage as prescribed above. Deduction follows a first in, first out basis, and the disallowed deductions can be carried forward and deducted in the subsequent 10 tax period. So here are some of the interests considered and covered under general interest deduction limitation rule. So the first one is interest component on financial assets and liabilities. This is something where the financial returns on a financial asset or liability comprise interest or other payments economically equivalent to interest. Then the interest component on those returns shall be considered interest expenditure or income for the purposes of the general interest deduction limitation rule, regardless of the classification and treatment of the interest component under the applicable accounting standards unless stated otherwise in this decision. The second one is amounts incurred in connection with raising finance. Interest shall include, but they are not limited to, guarantee fees, arrangement fees, commitment fees, and any other fees similar in nature. The third one is foreign exchange movement. This is something where an amount that is deemed to be interest under this decision is capitalized in the accounts of the taxable person in accordance with the accounting standards. Income and expenditure attributable to the capitalized interest amount shall be subject to the general interest deduction limitation rule. The fourth one we talk about is finance element of finance lease payments and non-finance lease payment. So the finance element of finance lease payment are documented in the accounts of a taxable person prepared in accordance with the accounting standards, and this includes both expenditure in relation to the finance cost element and income received therefrom. And talking about non-finance lease payments, this includes both expenditure in relation to the finance cost element and income received therefrom, and the other we have is capitalized interest and Islamic financial instrument. So the earlier provisions which were discussed, they shall not be applicable to the below mentioned. The first one we have is bank, insurance provider, a natural person undertaking a business or business activity in the state, qualifying infrastructure project person. So I'd like to give you a quick detail on this qualifying infrastructure project person. Basically, a qualifying infrastructure project person is a resident person that satisfies one of the the following conditions in the relevant tax period. First one is responsible for the provision, maintenance, or operation of a qualifying infrastructure project. And the second one is carries on any other activity that is ancillary to or facilitates the provision, maintenance, or operation of a qualifying infrastructure and any other persons which may be determined by the ministry. The second one we have is specific interest deduction limitation rule. It specifies certain situations where interest expenditure incurred does not qualify as a deductible expenditure. Exceptions under this limitation rule can be made irrespective if the loan was done with a related party, provided that the taxable person demonstrates demand. Purpose of undertaking the loan is not to gain corporate tax advantage. This is explicitly applied to transactions and respective interest incurred on loans obtained by the taxable person from its related party, like a dividend or profit distribution to a related party, a redemption, reduction, repurchase, or return of share capital to a related party, a capital contribution to a related party, the acquisition of an ownership interest in a person who is or becomes a related party following the acquisition. Now we will discuss about entertainment expenditure. These are expenditure where expenses incurred for the purpose of, but again they are not limited to the entertainment of existing or potential customers and to promote product and service. These expenses can usually be associated with personal consumption, hence should be in principle apportioned reasonably and fairly. In order to simplify this provision, entertainment expenditure is allowed to be partially deducted instead without segregating the expenditures attributable between the business and personal consumption. The allowable deductions for entertainment expenditure for corporate tax purpose is 50% of any entertainment, amusement, or recreation expenditure incurred during a tax period, like meals, accommodation, admission fees, transportation, facilities and equipments used in connection with entertainment, amusement, or recreation, and any other expenditure as may be determined by the minister. Now we shall discuss about non-deductible expenditure. So basically expenditures that do not meet the condition for deductible expenditure shall be considered as non-deductible expenditures. It will then be adjusted accordingly by adding back to the accounting income of the taxable person to come up with the taxable income. So here are the certain circumstances which do not allow expenditure to be deducted. The first one is expenditure not incurred for the purpose of the taxable person's business. The second one is losses not connected with or arising out of taxable person's business. And the third one is expenditure incurred in deriving exempt income. So here are some of list of expenses for non-deductible expenditure. Like we have donation, grants or gifts made to an entity that is not a qualifying public benefit entity, right, or other illicit payment, dividends, profit distribution or benefits which are paid to owners, fines and penalties other than the amounts awarded as compensation for damages or breach of contracts, withdrawals by a natural person or partner in unincorporated partnership. So amounts which are withdrawn from the business by a natural person who is a taxable person of this decree law or a partner in an unincorporated partnership, corporate tax imposed on a taxable person under this decree law, tax on income imposed on the taxable person outside the state, and input value added tax incurred by a taxable person. So concluding with the presentation, now you can drop your questions on our chat box and it shall be addressed shortly. Thank you.